Welcome to part two of my discussion with Kevin Davey. This one is pretty wild, actually. He's going to share an amazing story about how he was trading a strategy from a book, and it generated so many losses for him that he had to keep topping up his trading account. We're going to hear how he got into the situation, what he did to get out of it, what happened to his trading account, and also some invaluable lessons that we can all take away from Kevin's experience. So let's get into part two of my discussion with Kevin Davey. Now, for the second one, I wasn't really sure about this one when you suggested it, Kevin, but I've been thinking about it, and I'm really interested to see what this one is about. So, so this defining moment is called meeting repeated margin calls.
Yes.
Yes. You're a futures trader, so you purchase the contracts on margin, and sometimes you get margin calls. We'll let you explain why that was occurring. But I think really the principles in this discussion can probably apply to all types of markets. So I'm interested to hear about this defining moment of yours. So take us back to that moment when you started getting these multiple margin calls. What was happening?
Okay. Well, at the time, I wasn't doing algo trading. It wasn't called algo trading back then. I was still kind of feeling out different ways of trading. And one of the things I stumbled across was a method that was called scale trading, which in a nutshell, let's say you're looking at the wheat market. If the price of wheat is at maybe a 10-year low, the laws of supply and demand say that eventually that price is going to go up. Okay, you don't know when, you don't know how fast, and that kind of thing. So the idea behind scale trading was, well, once you identify something that's going to turn, that you think is going to turn, you buy it at certain levels as it's going down, like on a scale. So maybe every 10 cents that the price of wheat drops, you buy a contract. And then when the price goes back up, you sell it. And then if it goes back down, you buy it again and sell it. And so, what you really want there is for once you start buying, maybe it goes down a little bit, and then it goes up, and then you sell out a bunch, then it goes back down, you buy a bunch, you sell, and it's just like a money pump where it just keeps generating money for you. And eventually it goes up and goes to maybe a 5-year low, and then you're like, okay, now it's it's too risky, I'm out. So that's what I was doing or attempting to do. And it all sounds really neat in theory. Yeah, of course, the price of wheat's going to go up eventually, because farmers will stop farming wheat if they're not making enough money. And, you think all these things in your head, and then you can look at fundamental numbers, and pretty much whatever side you're on, you can find fundamental numbers to justify whatever you want to think.
Yeah.
I mean, hey, the price of wheat's going up. Oh, why? Well, because the population of the world is going to be, in 5 years, it's going to add 1 billion people. Well, those people will need to eat wheat. Oh, okay. So wheat shouldn't be this low. Your mind invents all sorts
Justifying.
of things. Yeah. And so what I was doing was I was buying as the price was going down. And so I was adding to losers. So the price would fall 10 cents. I'd buy another contract. Then the price would fall. Now I lost on the first contract and the second contract, and I had to buy another one. Well, as you can imagine, eventually that kind of thing gets to the point, if it doesn't turn around, where you get yourself into a hole that you can't get out of. And that's kind of where I was. And it sort of became oh my goodness, this has got to turn around or I'm doomed. And that's when I would get hit with margin calls. And literally I'd go to the bank at lunchtime to wire money to my brokerage. And this was maybe once or twice a week. And it was so bad that I got to know the wire transfer lady at the bank on a first name basis. I knew all about her grandkids. I literally actually bought her grandkids gifts. And this is how messed up I was. I'm like, I look back at it now, I'm like, what was I thinking? I'm buying this wire transfer lady. I'm buying her grandkids little toy cars and stuff. It was like, stupid. And, eventually it got to the point where I just I had just lost so much. And I'm like, I don't have anything left to give. I'm drained and I'm out. And I packed up that method and kind of licked my wounds and went off and, started investigating other ways to trade. And it's kind of a hazy memory now. Thankfully, they say like traumatic things become hazy and you don't really remember. But if I recall correctly, the price after I left still kept going down, but eventually it kind of leveled off. And, if it had been a couple of years, I would have made that money back. But, there was no way I could stomach something for that long. But it was just margin call after margin call. And, because I was so tied to that position, all my thoughts were, oh, well, wheat is going to go up and, I can't be proven wrong. And, psychologically, there's just a whole bunch of baggage that comes with tying yourself to a position. And then, it just drags you down. And, I know I'm not the first one to have that happen, but it is definitely adding to losers is no way to live. That's for sure.
Yeah. So when you started trading this strategy, what evidence did you have that it actually worked?
So I had this guy wrote a book. So of course, hey, he wrote a book. It's got to be true, right? And every example he showed, oh, it worked. It worked again. And, but at the bottom, there's some little caveats. Well, this might not always work, but it's in super 6-point font and you can't even read it. And so you think, oh, well, of course this is going to work. But it was something that I started doing, and I started doing it in a couple different markets, and it actually did work. And there was one year I remember before this debacle where I think I made over 100% return on a smaller account, but I was pretty confident that this could work. And, I think the whole idea still, I tell people it sounds so reasonable. Because you say, well, hey, if it's at a multi-year low, a 10-year low, well, chances are it's going to come back. But the tough part is you don't know the timing of it, and you don't know how jagged it's going to be going up and that kind of thing. And you don't understand that you have to live through that down part. People always think, hey, I just grab the bottom and then start buying. Well, with this method, you actually want it to go down a little bit more against you so that you can start this buy, sell, buy, sell, buy, sell kind of thing. But I was convinced it was going to work. But, here's somebody in Cleveland, Ohio doing fundamental analysis on the wheat market, which I had no business doing. And somehow I determined the price was going to go up in the next couple months. It's just silly to think about. But I think we've all done things like that where we think we know more than anybody else out there. And what I've found is the market always proves you wrong. The market knows more than all of us.
Yeah. Yeah. So if you were so confident that that strategy was going to work, what was the moment where you went what am I doing? This is because I imagine if you're this, this sunk cost fallacy or what's it called? Something like that.
Yeah.
Where, I've put this much into it. Now I've got to keep going because it's going to turn around. How did you switch from that to, I've just got to get out? It's like, this is ridiculous. What am I doing?
I think it was basically I realized that I couldn't go on meeting margin calls forever. And that, I just reached the end of my account, basically. It wasn't me saying, oh, well, hey, I've lost 10% of my money. That was my quitting point. I'm getting out. No, it was more like I'm almost out of trading capital. This is pretty much it. And I'd have to go back and look, but I'm sure I took some even more extraordinary gambles just to try to get it back, kind of like, oh, okay, there's a wheat report tomorrow, so I'm going to buy more and hope it jumps up kind of thing. And then I'll scale back, but, try to rebuild. And it was definitely a prolonged process. It wasn't something I came to overnight of, hey, I just got to get out, even though I know I should have.
Yeah.
It was there was so much tied up into it. It was ego. It was just confidence in the method. And here you're throwing everything away. If you quit, you can't quit. There was a lot to it, and it but eventually, once there was no more money, that kind of ended it for me.
Yeah. So I think it's usually a good experience for traders to go through a big drawdown like that, because then they can really, I guess they can figure out what their sensitivity is to losses and where their appetite for drawdown is. What did that kind of experience do for your, your understanding of how you cope with drawdowns?
Well, for one, it just made me realize that adding to losing positions was almost never a good long-term scheme. In the short run, a lot of times things work out and, you double down and it comes back and you can get out. But just the psychological part of losing and then adding to that loser I just realized, okay, that's just something I'm not doing. And so looking ahead now at all my algos that I have, I don't have any that do that. There's none that add to losers. I have a few that add to winning positions, but none that add to losers. And I think that's an important, that was probably the biggest lesson I learned out of it, was just stay away from making a bad situation worse.
Yeah. Any other positives you can think of that from that experience kind of led you down the path of algo trading and how you trade now?
Well, yeah, I mean, it probably did lead to where I am now, which I feel pretty happy about. And if I had had success with it, there probably would have been another event further down the road that probably would have cost me more money, because I didn't learn the lessons. And that's why I always, you mentioned it's good for people to lose and experience drawdowns. I think some of the scariest traders I know are the ones who've had immediate success right from the beginning. And, after 2 months, they're like, oh, this is so easy. I'm going to make 200% a year, and there's only a 5% drawdown, and, this kind of stuff. And you feel bad for these people because, eventually things are going to turn around, and they're not going to be prepared for it. And really, they're going to be the opposite of prepared for it, beyond ill prepared, because they've experienced success and they think that's the norm. So it's almost better to experience the losing at first, and then you can kind of accept the winning a little bit better. You know what to expect, but it doesn't make it any more fun. So,
No. Yeah. And what about your attitudes to risk management these days? Is there anything that was kind of defined by that period of your trading?
Yeah, I mean, I got away. I definitely started to think more about diversification, and, that spilled over to my algo trading of, hey, you have multiple strategies in multiple markets, don't fixate on one market. And that turns out to be a really good way to smooth your equity curve. But that being said, if you become an expert, let's say on the wheat market, and you can do well with it, well, then you don't have to necessarily be diversified. Just if you can do well in one market, and you think that's where your sweet spot is, I just stick with that. That's not necessarily a bad thing either. But I realized for myself that I was never going to become an expert in any one particular market. So I tried to become this general expert and spread my risk around.
Yeah. So for anyone then who is perhaps going through some large drawdown now, what would you recommend to those people?
Well, I guess the big thing, if you're in a big drawdown, take a look at why you're there. And this could be completely normal. And it's just the strategies you're trading. You could get some sizable drawdowns. So make sure you look at that and understand, well, why am I having this drawdown? Is it because I'm not following my rules? Is it because I'm doing something with my psychology where I'm adding to losers when I shouldn't be, or doing things like that? That will help you at least define why you're doing it. If you look at a lot of the big funds out there, the big commodity trading firms or even hedge funds, they have big drawdowns. I mean, it's not uncommon to see somewhere in their history, they had a 50, 60% drawdown. But I can tell you probably they expected it. They weren't shocked with it. And then if you're expecting, hey, there's a 1% chance or a 5% chance I'm going to have a drawdown like that, you can at least plan for it, and you can also see yourself through it. What happens with most people, though, is they hit these big drawdowns and they panic, and they usually end up quitting at the absolute worst time. I had a friend who sold trading signals, and he would always know when his trading signals would start doing bad because he'd get a whole bunch of subscribers. And the more subscribers he had, he knew the closer he was to a peak in his system. And then when he'd have an inevitable drawdown, he knew, as he kept losing subscribers because they all bailed, when he got close to zero, he knew that was probably the time when his system was going to turn around and start trading well again.
Yep.
And he said it happened so many times, it was incredible, where if the people had just stayed with it and realized, hey, these drawdowns are just normal, they would have been a lot better off. But handling drawdowns and thinking about drawdowns, and it's very tough, and it's living through them is no fun, that's for sure.
Yep. Yeah. Do you trade wheat?
I do not have any systems for wheat.
Okay.
Any algos for wheat right now.
Is that intentional or subconscious?
For some reason, it's a hard market to come up with algos for, but I would trade it if I found something that was worthwhile.
Yeah. Okay. All right. Well, thank you very much for sharing that defining moment with us, Kevin. That was really interesting. So that was talking about margin calls in wheat trading. Sorry, I've forgotten the name of the strategy. What's it called? The scale.
It was called scale trading.
Yeah.
And there's probably there is definitely a book out there on it. I'm looking on my bookshelf. I don't see it.
Don't recommend it, Kevin.
I might have burned it at some point.
Don't look up the book, people. Don't look it up. If you want a book, get Kevin's book.
Actually, now I recall the title. It wasn't scale trading. It was called "You Can't Lose Trading Commodities." Which, that should have just tipped me off. But
maybe you were the one exception, Kevin. Everyone else couldn't lose, but you. So that's it for part 2 of my discussion with Kevin Davey. Now, in the next part, Kevin's going to share another key defining moment of his trading career, which really taught him a lot of things about the role of luck in trading, setting goals, learning from setbacks, and much more. This is super valuable information for traders, so make sure you capture part 3 of my discussion with Kevin Davey.